Today on the Joseph Carlson Show, I'm happy to report that Google won. They won with getting the most favorable outcome of this antitrust lawsuit. This lawsuit that's been overhanging Google for the better part of 5 years is now finally seeing an end. Judge Mehta has decided that Google will avoid the worst possible outcome, which of course was selling off Chrome. The Chrome browser plays an integral part in connecting all of Google's services together. It is the access to the internet, and being forced to sell that would have been disastrous for Google. But the judge is saying that that's a step too far, that it doesn't fit with this trial, and Google gets to keep Chrome. The stock is now up 9% on the day, reaching all new highs, in fact, far surpassing all new highs. It's now at $230 per share. But there's a lot more that goes into this case, and we're going to be going over some of the key details, and in fact, reading some of the case itself, because this was a very nuanced decision, and there's a lot more that goes into this than just Google and Chrome. It changes the way that Google interacts with other businesses like Apple, and it changes conditions and requirements for Google to share information with other companies. So there's a lot to consider with this decision, and we'll be going over all of it, the full outcome, how this is a clearing event for Google, what it means for their future, and the valuation of Google as I continue to hold this company as one of my larger positions. We also have Google's statement on it, how they see this decision from their own legal team. And of course, we have a lot of commentary and takeaways from this. Some people are upset that Google's not being ripped apart and torn up, thrown into the trash. Jonathan Cantor, for example, is upset, saying that this was a missed opportunity for the judge to reinvent the markets, to make the markets like the judge wants to make them. So Jonathan Cantor isn't happy about this outcome. We'll be looking at his comments. We also, of course, can't forget about the expert here, Gene Munster, who just 3 months ago said that Google was eBay, suggesting that Google would have a slow, horrible decline into obsolescence. And now he's on TV saying that Google's his new long, that he's now very bullish on Google. We'll be looking at the remarkable turnaround of many market commentators on Google and how this trend is going to continue in the future. We also have Mark Mahaney, one of the best analysts out there that was once again right on Google. He's one of the few that stuck his neck out on Google when it was most in question and said that he's long the company, that it's undervalued. But even after this ruling, we agree that Google remains undervalued. I shared my case for Google being deeply undervalued yesterday, and we'll be looking at Mark Mahaney's case for it being undervalued today. Now, there's other things to consider with this Google ruling outside of Google itself. This also is seemingly a win for Apple. We'll be looking at how it impacts Apple as well. So we have all that Google news to get into, plus a lot of news outside of it, like Netflix is now letting users customize clips and share them on mobile. And then we're going to be going over 2 different apparel and fashion brand stocks. One of them Lululemon, the trendy athleisure brand, and the other Crocs. I'll be going over which one I think is the better buy in this episode. Now, to kick things off, before we look at the gains and how this impacts the portfolios, we have to break down what actually happened. What was this decision from Judge Mehta? Well, there's 4 basic parts of this decision, the most important of which, the big headline, is the big question was whether or not Google was going to be forced to sell off Chrome. Chrome is an incredibly important property of Google. It's a browser that has billions and billions of users. It connects all your disparate Google properties like Gmail and YouTube, like Google Drive. It has combined logins for all of them, so you have all of those accounts synced. It syncs your bookmarks. It has nice integrations, and it has extensions that they use with their properties. So this is something that gives you access to the web. It's a big, important property for Google. And one of the major considerations that the judge was going to decide was whether or not Google would be forced to sell Chrome. Now, the judge is not forcing Google to sell Chrome, so that's the big win in this case. Now, there are still restrictions, which Google investors fully expected, but these are restrictions that are far better. In fact, it's the most favorable outcome that Google investors could have asked for. The U.S. District Judge Amit Mehta in a Tuesday ruling said that Google can't pay to be the exclusive search engine on devices and browsers. And that's the differentiator. They can still pay Apple, they can still pay these other companies, but they simply can't pay for exclusivity and box out competitors entirely. He said that he allowed the company to continue making payments for distribution of its products, saying a prohibition on those agreements would harm recipients such as Apple. The judge wasn't trying to protect Google in this case. They're trying to protect Google's customers. Google's paying all of this money to be defaulted, and these companies like Apple and Mozilla and all these other companies, they're the beneficiaries of being paid. Google's handing out a lot of money to these other browsers and other distribution platforms. So if Judge Mehta said Google can no longer pay them, Well, Google would keep all that money, they would likely still be fine, and in that case, it would really harm Apple and Mozilla and all the other browsers. And this is a theme that we see repeated throughout this case. Harming Google would also be harming an entire ecosystem of companies and products. In many cases, it would also harm competitors. So Judge Mehta is trying to find a solution that does not cause undue harm to all these businesses in this ecosystem. Mehta said a judge's job was to approach remedies with humility, and he said that the competitive dynamics of the marketplace were changing already, largely because of artificial intelligence. In fact, if we look at the introduction to his decision, we have the full decision here. There's 230 pages of this, and at the very beginning, Judge Mehta talks about the reason why he isn't forcing Google to sell Chrome. And the basis of his decision is the evolving landscape of competition. He says that much has changed since the end of the liability trial. Google is still the dominant firm in the relevant product markets. No existing rival has wrestled market share from Google, and no new competitor has entered the market. But artificial intelligence technologies, particularly generative AI, Gen AI, may yet prove to be a game changer. Today, tens of millions of people use Gen AI chatbots like ChatGPT, Perplexity, and Claude to gather information that they previously sought through internet search. These generative AI chatbots are not yet close to replacing GSE, which is the general search engine, but the industry expects that developers will continue to add features to Gen AI products to perform more like general search engines. Now, what is the judge doing here? Well, the judge is actually being smart here. He's using thoughtful, forward-looking and backward-looking analysis. He's actually looking at the state of the competitive dynamics of this market. He's trying to understand not only where Google sits today, but where it will sit in the very near future. And what he's observing correctly is that Google does face competitors. Competitors with search, competitors with Gen AI. Now, I would bucket these groups into a category I call information gathering. When people go online to get information, that is an act of searching or general AI, and the lines are getting blurry. And like Judge Mehta is pointing out here, there is competitors in general AI. There's competitors like ChatGPT, Perplexity, and Claude. We've seen these rapidly gain users. So I think the judge is actually doing a good job of looking at this holistically, looking at the entire industry dynamics, and being forward-looking that many of these competitors like Perplexity, ChatGPT, and Claude are acting more and more like search engines by the day. They're now scraping the internet, pulling responses from Reddit. They're pulling more relevant and more new news. These are transforming into search engines over time, and the judge sees that and is making note of it. The emergence of Gen AI changed the course of this case. So when we read through this, at the very beginning, we can see the judges being thoughtful in tailoring the response and noting that Google does face competition, which is something that I've been saying for years. Part of the reason that Google has traded at an 18 and 19 forward PE ratio, while the rest of any comparable company trades at a 27 to 35, is not just because of the uncertainty of this case, but also because Google faces a lot of questions. Primarily, does ChatGPT eat into their market share? Is it now ChatGPTing things rather than Google searching them? That was a massive question for investors. It brought in a lot of uncertainty. So Google is facing a set of new competitors. I think they're competing well, but this is a highly competitive landscape. And the judge is now recognizing that more than he did a couple years ago. Now, with Google, this is part of the reason they avoided the harshest penalty, is because of these competitors, which is ironic in a way. In a way, if you really think about it, ChatGPT, Perplexity, and Claude actually saved Google. They saved the company from being broken up. They are these so-called competitive forces, making it so that Google doesn't look quite as much like a monopoly. So the most severe punishment for the monopoly was taken off the table. If ChatGPT, Perplexity, and Claude didn't exist, if this never happened, sure, Google wouldn't have that big overhang in question of whether or not they can compete with ChatGPT, but they would also likely have the harshest punishment from the ruling. They would have Chrome be sold off and given to a competitor. So in a way, ChatGPT and Perplexity and Claude saved Google. They didn't harm it. Judge Mehta wrote that there are strong reasons not to jolt the system and to allow market forces to do the work. And that again is the correct answer. Google already, again, faces all these different dynamics. They're constantly having to evolve and change their services. They started with AI overviews, which gave you a snippet of an artificial intelligence answer. Now they have AI mode built into search. They have genuinely new innovations all the time. They came out with the Gemini app and they're trying to grow that. The company is not sitting on its laurels as a big monopoly, just increasing prices. That's not the situation going on here. And although they have a dominant market share, they are forced to compete every single day to maintain that market share. So Judge Mehta is correct in saying that there are market forces forcing Google to compete and adapt. Google cannot stay the same and win. Now, overall, this ruling by Wall Street was considered a massive win for Google and for Apple. We'll get to Apple in a minute, but it allows this existing arrangement to continue in which Google pays Apple more than $20 billion a year to be the default search provider on Safari browser. Now, I've said before that I think Google would be fine not paying this. Basically, what would happen is immediately Google would have another $20 billion to play around with. That $20 billion would drop right to the bottom line. So this $70 billion in free cash flow, give or take, would all of a sudden be $90 billion, which they could give back in buybacks or issue with dividends. They could return it to the shareholders. They could invest it in CapEx or do what they want with it. So that would be a big benefit to Google in the short term, but it would also weaken their moat slightly. They wouldn't have quite the same security that they have with Apple, and Google's willing to cough up that money to continue keeping that security, to make sure they always remain with their largest market share. So the single biggest takeaway from this is that Google won by virtue of not having to sell Chrome. That in and of itself is worth the stock being up 5 to 9%. You see it trading up 8, 9% today. That is because of not selling Chrome. And again, Chrome is not a big revenue generator, but that's because Google uses it in an intelligent way. They use it to drive adoption and consistency across all their other products. It's kind of like the glue that glues all these different services together. So even though it's not directly a revenue generator, it is uniquely valuable to Google. The other part of this decision does affect Google with their data sharing. And this is where Google has some penalties. Some things were worse than they were before. Google will also have to share some search data to give competitors a shot at building the scale they need to offer better search results. The reason that Google continues to win in search is because of all the data they have. It is a virtuous flywheel. The data feeds better search results. The better search results feeds more usage. The more usage feeds better data. And that flywheel has been going on forever for Google. Meta said that data sharing was necessary to dilute the advantages Google gives from paying to be the default search engine. He didn't require the company to share advertising data. Now, you can go into all the technicalities of what Google's being required to share. It is some important data, but it's not the most important. They're not sharing a lot of the graph data that was the most crucial for Google to keep secret. But overall, this is the biggest penalty for Google, the fact that they're going to be forced to share some of the data with competitors. Another thing that didn't happen, another win for Google in this case, is the Justice Department had asked for Meta to require Apple and others to give users choice screens. Like when you get a new phone, you have to go through a big list of default options for your search engine, and Google might be on like page 2 or 3, you have to scroll through. That effectively tries to get people to choose other things in Google search as their default, even if they want Google search as their default. The judge in this case said that remedy went too far because it intruded into product design, a red line that courts shouldn't cross. And that's exactly right. This is where you see a huge differentiation between US judges and European judges. The judges in Europe have no problem crossing the lines into product design. They will intentionally change the design of user interfaces, of products, of software to meet their requirements. In this case, the judge did not want to get into the business of trying to design the onboarding of an Apple product. So overall, there's no other way to really say this than you won. If you're a Google investor, you just won. You chose a great company, you made a great investment that is now soundly beating the market. That did so because of its fundamentals and because of a very sound, rational ruling from the judge. If this judge decided to rip apart Google and forced him to sell Chrome, that would have been a grave injustice. That would have been incredibly unjust for this company. Google did not buy Chrome. They didn't acquire it from some startup and pay him out to just win it over. Google built Chrome from the ground up. They designed it. They grew it. They were great stewards over it. The reason that Google Chrome is still continually used in Europe, even though people have to select which browser to use, but everybody's using Google Chrome, is because they like Chrome. It's free, it works good, it's very secure, it's always updated. Google has been fantastic stewards over that property. The idea that Google Chrome could have ever been sold off to the likes of Perplexity, people that have never managed a huge product at scale anywhere close to Google Chrome, people that didn't build Chrome, people that don't deserve Chrome, would have been a massive injustice, both for Google shareholders, employees, owners, everybody involved, as well as an injustice for the people that were able to buy Chrome unfairly because of a single judge. A single judge that had nothing to do with the growth of Google over the past 20 years should not decide whether or not a massive property that they've built and own and have been good stewards over gets sold off and hawked to competitors. So I'm very happy with this decision. Not just because I'm a Google shareholder, of course I have a financial incentive to be happy about it, but also because it's right. It's fair. Google does deserve to keep Chrome, and it would have been potentially incredibly damaging for the market and the industry to have this type of interference from a single judge. Overall, the correct decisions were made. The judge was thoughtful, deliberate, and targeted in his approach. He didn't let Google off scot-free. It's not a case where Google doesn't have to give anything. In fact, Google made a statement saying that they're not pleased with the fact that they have to share data. They're worried about safety and security of their search data while giving it over to rivals, so they might appeal that part of the decision. But overall, this is a much better decision, and it's one that I think is the best that Google investors could have hoped for. It is the best and most fair outcome for this company. Now, Google investors did win, and I think it should be celebrated. If you look at your portfolios and you invested in this company, many of us were talking about this stock when things were very uncertain. Here's a video I made on Google 4 months ago. This was April 25th, 2025. Now, 4 months ago may not seem like a long time ago, but Google was trading at $164. Expert analysts like Gene Munster were on CNBC bashing Google, calling it an eBay, saying its products would slowly decay into irrelevance. This was after Google's recent report where they were not getting the due credit from their earnings. Even noting the long-term uncertainty that remains with a new competitive dynamic, I still continue to believe that Google is undervalued today. The stock is worth more than $200. Considering the competitive dynamics and the strength that Google has shown in the face of it, and the different properties this company owns, from Waymo to YouTube to cloud, this company has many tools to grow its earnings, many tools to return a lot of cash flow to shareholders, and I believe this one will eventually get back up above $200 per share. This earnings report should have made investors incrementally more bullish and have a sigh of relief with many of the narratives being shared. The price point was at $164 4 months ago. Google stock has increased by 40% over those 4 months. This has been a massive winner. And investors that use those opportunities to add more shares or at least remain bullish on the company, to not compare it to Kodak or eBay, benefited greatly. And you see the sentiment overall changing. And I think it's a win worthy of celebrating. In my portfolio, Google remains one of my largest positions because it continues to just grow. It's actually growing into a much bigger position. Now it's a $75,000 holding in the tech category in the passive income portfolio, now $17,000 of gains. Around $6,000 of this gains is just from today. In the story fund, I also have Google as one of my 6 positions here. Google's now a $49,000 position with $26,000 in the green. And again, another $3,000 or $4,000 of that being just today. So overall, just today, Google's up around $10,000 in my portfolio. Not a bad day. So congratulations to every Google investor. You won, and I don't think you're going to stop winning at this point. I think that Google will continue to go higher. Now, at the same time that we celebrate winning in this case, there's some people that are upset that Google wasn't punished more severely, that the judge didn't rip apart Google. Here's Jonathan Cantor saying that this was a missed opportunity to change the markets.
Yeah, it is disappointing. I think the court really had the opportunity to do something transformative here. And the decision that the court issued a number of months ago was quite bold, and it gave the court a lot of discretion to impose a remedy that didn't give Google the benefit of the doubt. And I think the part that perhaps gives me the most heartburn is the court kicked the can down the road in terms of the issue about whether Google can continue paying companies like Apple billions of dollars a year for distribution. It said that Google could, but if it turns out the remedy doesn't work, then the court is willing to revisit it and then revise the remedy. And I think that for a company that has, like Google, that has been found to violate the antitrust laws, something more definitive would have been far more preferable in this instance.
Yes, you heard that right. This was a missed opportunity. It was a disappointment that the judge didn't hack and slash Google apart, selling off random parts of it like Chrome to competitors. Competitors, by the way, that are growing substantially, that are well capitalized, that have every means to compete with Google. Many like ChatGPT, Perplexity, they have all the money in the world to be able to compete with Google. But you have Jonathan Cantor here, very upset that the judge wasn't more aggressive in this case. Jonathan Cantor doesn't want these companies to compete. He just wants Google to be punished. That's the basic takeaway here. There's some people that just want Google to simply be broken down and taken down a peg. They don't really want to fix competitive dynamics. The problem with Cantor's take here is that he's not addressing the core concern, which was that Google was the only way to gather information. And now there are many, many ways to gather information. Now, next up, we have Gene Munster. Another person that, Gene seems like a nice guy. This is nothing personal, but he was dead wrong on Google. He just got it completely wrong. His advice just 3 months ago. Now, this wasn't like a year ago. This isn't like time to have some big transformative change on the subject. This was 3 months ago. Gene Munster said quite confidently that Google was eBay, a company that has a slow decline into irrelevancy, a slow decline into antiquated businesses. Now, after just 1 or 2 earnings reports, after the company has this decision, and most importantly, after the general sentiment has changed for the positive, Gene Munster has flipped his entire thesis on Google on a dime. It's just changed, a complete 180 all at once because of a sentiment change. Now, that's common amongst retail investors. That's common amongst many investors that are inexperienced, that haven't done this for a long period of time, but that's not that common amongst experts. People that are supposed to have real theses on foundational evidence, on things like the fundamentals, the earnings reports, the consistent growth of the company. The reason that I invested in Google and stayed invested through it, throughout all of the ChatGPT threat, was because of the numbers. I've highlighted it again and again and again. You look at the numbers to actually see what's happening. People talk about anecdotes all day long. They say that my friend or my cousin only uses ChatGPT. He or she stopped using Google completely. So I'm going to sell out of Google stock. Well, the numbers show the true picture. The revenue growth of search is a lot of these anecdotes put together. And that's simply all data is. It's a lot of anecdotes compiled and represented in broader numbers. When we look at what's been going on with Google, they've been growing their search query volume and their revenue consistently throughout all of this. And that's what kept me in this stock, and it's what I've referenced over and over again. The problems with basing your opinions on simple anecdotes, not the broader data, and basing them off of market sentiment at the time, is that all of these things are fickle, and they can change on a dime, just like Gene's opinion on Google. Here he was again 3 months ago, comparing Google to eBay.
So my version of that isn't quite as harsh. It's that they're the next eBay.
So he's saying, no, Google's not Kodak. They're not going to irrelevancy overnight. They're just eBay. It's going to be a slow decay over time. Now that Google's $230, he's all aboard the Google train. He's very bullish on the company.
Melissa, this is good news, of course, because the regulatory bark is much bigger than the bite. They're more lenient. That's positive. It's positive for Apple, positive for Google, but also positive for Meta. Surprised that Meta's not up more. I would just point out one angle related to why Google's up so much. This turning of the page on the regulatory allows investors to think more about the progress that they're making in terms of AI overviews, AI mode, these 3 panels, their search panel. Those are the 3 interfaces that people use. They're making more progress at getting those adopted. Had some remarkable speed of that over the last few months with AI mode. And so I think that that's one piece to it. Another thing that's really jumped out to me is just putting this through the ringer. If you go below the surface, the impact to Apple and their ability to kind of have the upper hand, I think maybe a little bit, that view may be a little bit misled.
There you have Gene's take. He says that this is a notable benefit, not just for Google, but for the entire AI space. And of course, he always adds in his favorite company. If anything bad or good happens to any other company, it's a good thing for Apple. That is the way that things always seem to end up in Gene's mind. And in this case, there is reason to believe that Apple will maintain part of the relationship. They'll still get those paychecks for Apple, but he's viewing this as some type of big game-changing moment for Apple, which I don't think is the case. Now, one of the few analysts out there that's not a retail investor that actually remained bullish on Google throughout all of this, throughout all the uncertainty, the doubt, all the people saying that ChatGPT would destroy it, was Mark Mahaney from Evercore ISI. Now, just a day ago, before this decision was made, I made a video saying that Google was 50% undervalued, meaning that it had another 50% upside. And here we have Mark Mahaney a day later, after this decision, saying that even though Google's up 9% today, it remains his top pick. It is still undervalued after this move.
Well, we guessed that there was going to be that Google was going to be able to avoid a worst case scenario, and they did. I think the results actually probably for Google bulls like myself, this was probably better than we had thought likely. But I read through the judge's decision as much as I could at 230 pages, and I think it's a very thoughtful approach to search and technology. And that sentence on that first page that says that things have changed because of Gen AI. I think that's exactly what most people who follow tech would have wanted to have seen. Of course, the facts have changed on the ground. And we think, personal legal opinion, that's not worth much, is that the judge made the right call here, which is that let technology determine market shares going forward. He identified a monopolist, he laid out some strictures, and he's also fully respectful of what's happening in the market as a whole. So anyway, from a stock perspective, this was clearly a clearing event for Google shares. And we continue to like the stock. It's our number one pick because now you get to the fundamentals. This distraction is behind us. Now you can focus on the fundamentals, and valuation, I think, is still highly attractive.
If you were a little bit hesitant, I think that you can change your mind. There's nothing against that. But I do think you get extra credit for remaining bullish on Google and having resolve during the low points. It's much easier for investors to become bullish on companies when the sentiment has changed. If investors like you and me are having sentiment dictate how we feel about a company, that is not a good situation. We want the data, the numbers, the fundamentals to dictate our sentiment. In this case, Mark Mahaney is an example of an investor that did not let the previous negative overall overweighing sentiment on Google to impact his personal sentiment on the stock. Now he outlines the road ahead for Google, what this company needs to do to continue growing for the stock price to go from 230 to 250 to 270.
Okay, so first, the core catalyst has got to be they got to maintain that double-digit search revenue growth. They've been at 11, 12, 13% for about 2 years now. We think that'll continue because what's underappreciated by the market is the quality of Google leads is actually rising. And it's kind of the law of unintended consequences. You show people fewer paid clicks so that when they click on them, they're less casual, they're more conscious, determined, whatever it is. But the marketers we talk with, the advertisers, are seeing higher quality leads coming from Google. That's causing pricing to go up. That's a good thing for Google. And then secondly, just like Meta, Google has been able to use Gen AI to improve its ad targeting, its ad selection. So you've got a search marketplace that's getting better. That's your core catalyst. If that continues. Then you got what I call these amplification catalysts. That's YouTube revenue. That's accelerating. That's Google Cloud revenue. That's accelerating. And then Waymo is coming to a town near you. And you put all that together, I think the stock's worth more. You put a 25 multiple on this or next year's numbers, you get to like 275 on 2027 earnings numbers. You get to 325. So somewhere in between there is probably where the stock can go, called $300. I think there's still a lot of upside. I like Google here.
Now, Mark Mahaney's price target for this company is around $300. Now, the temptation here is always when you have a successful investment, especially if you haven't had many, and this is like one of your first times a stock has moved up substantially, in many cases, you might want to take the gains. You don't want to have the gains be taken away from you. But in cases where gains are taken away from you, are typically if the company traded above the normal valuation into a territory of extreme exuberance, a valuation that's very difficult to justify over a longer timetable. When we look at Google and the current valuation of the company, even after today's massive move, it trades in the low 20s. This is a valuation that it's deserved for years and has never gotten. It's finally in the low 20s, even though Google has moved up to all-time highs at 230. The fundamentals are not telling me to sell this company. It doesn't feel overstretched with this valuation. It doesn't look like growth is slowing or has topped out. It doesn't look like it's met its market saturation. And when you compare it to its most comparable companies, it trades well below them still to this day in terms of valuation. And if you believe that Google can continue to compete with the likes of ChatGPT or Perplexity, then this is a stock that I'll continue to hold. So as of right now, I have no intention of selling this company. So once again, congratulations to Google investors. You won today. Now, moving on, we do have some other news with different stocks outside of Google. One of them is Netflix. Netflix will now let users customize and share clips on mobile. This is just another small iterative development for Netflix, another thing they're doing to advertise. Netflix announced a new update to its Moments feature, allowing viewers to choose a start and end point on clips to save and share. The update includes a clip option on the screen to adjust the length of the segment. After it's clipped, the video will save to viewers' My Netflix tab for rewatching and sharing. Now they have a little screenshot of what this looks like. It's a basic timeline. You can just put the start point and the end point, and then you can share this clip online. Now, this may not seem like a big deal, but whenever Netflix does something, they do it at scale. And I could see these type of mobile clips being shared on platforms like Instagram Reels or TikTok, making a lot of Netflix's content go more viral than it is today. Because right now it's difficult to share any part of a Netflix show. So I see this as another smart adaptation of Netflix over time. They're trying to get better shareability, making it more like YouTube, where they can have more organic growth. Now, finally, we get to two other companies that aren't having such fortunate luck as Google. We have Lululemon and Crocs. And I wanted to take a look at these battered down athletic and fashion brands, ones like Crocs and Lululemon, and see which one is in a better position right now. First of all, we have Lululemon with a 13 to 14 forward PE ratio. The stock has gone down around 46% year to date, so a massive decline in stock price. It's attracted a lot of value investors to it. And the biggest problem that Lululemon's facing is it's dealing with heightened competition. The revenue is rapidly decelerating. The earnings estimates for their growth rate has gone down dramatically. The free cash flow is also declining. Lululemon is now turning away from its organic growth, mostly by word of mouth, to now looking into actually doing sponsorships and paid advertisement. Now, at the same time, we have another fashion brand, maybe not the same style of fashion. This certainly isn't athleisure. This is just leisure. Crocs owns the Crocs brand, of course, and they also own Hey Dude. These are two of the most casual leisure brands that exist, and this is another company that's had a relatively tough year, not quite as bad as Lululemon's. First of all, the Crocs valuation is super low. Not just low, not just below peers, it is extremely low. It has a PE ratio, forward-looking, that's below a 9. Now, a commodity multiple, meaning that investors are basically pricing in no attractive gains at all, is around a 13. So when you're trading below a 9, that means that investors are pricing in the worst case scenarios, that your business is basically not worth buying, not worth owning, that the share price will never go up, that they can't resume growth in any capacity. And we can see in the numbers that Crocs went through this massive growth stage in 2022, and now it's decelerated sharply in 2024 and 2025. Now it's just growing at 2% per year. Out of the two companies in the situations they sit in right now, I would rather own Crocs than Lululemon. I think the valuation gives it less downside, and if there's any increase in growth at all, any revenue increases, Crocs should move up to double-digit PE ratios. A 10 to 13 PE ratio would be a massive gain for this company. Now that's going to be it for this episode. Hope you enjoyed, and I'll see you in the next one.